In this video, we'll be taking a look at IAS 1, Presentation of Financial Statements. Now, there are a number of reasons an entity will put together a set of financial statements. They include showing the financial position of the company. This will be shown in the Statement of Financial Position, formerly known as the balance sheet. The financial performance of the company will be shown in the Statement of Comprehensive Income, which was previously known as the Profit and Loss, or the Statement of Changes in Equity. The cash coming into and going out of the company will be shown in the Statement of Changes in Cash Flows. Further details about the financial statements and any relevant policies, disclosures, and explanatory information will be contained in the notes to the financial statements. Now, financial statements produced under IAS 1 must have the following features: fair presentation and compliance. This means that the financial statements shall be presented fairly as set out in the framework and in accordance with IFRSs and shall comply with the requirements of all the IFRSs. Statements will be produced on a going concern basis unless there's a reason to produce them on a breakup basis. This would be if management intends to liquidate or cease trading, or has no alternative but to do so. Accounts are prepared on an accrual basis. This is when items are recognised as assets, liabilities, equity, income and expenses when they meet the definitions and recognition criteria, with the exception of cash flow information. The financial statements will present separately each material class of similar assets and items of dissimilar nature or function unless they're immaterial. Offsetting is not allowed under the international accounting standards unless it's required or allowed by another international financial reporting standard. IAS stipulates the frequency of reporting should be annually, and if not, it should be disclosed. Comparative results from the previous period should be shown in the account unless it's impractical to do so. So this means you'll show last year's results alongside this year's results so that the users can get an idea of how they've changed. Also, the financial statements from year to year should be consistent. That is, the accounting policies and methods used in previous periods should be used in this period too. The Statement of Financial Position will show an entity's assets, liabilities, and ownership equity at a given date. The assets of the company will include such things as cash, receivables, inventory, property, plant and equipment, intangible assets, and investment property. Liabilities include payables, loans, and provisions. Equity will contain things like non-controlling interests and issued capital. There are two options for presenting the Statement of Financial Position. An entity can list the items separately into current and non-current sections. Current assets are those held primarily for trading and expected to be realized within 12 months. Current liabilities are those expected to be settled within 12 months in the entity's normal operating cycle. All other assets and liabilities will be classified as non-current. Or an entity may choose to present the assets and liabilities in the order of liquidity. A Statement of Comprehensive Income will show the net income, expense, and profit of an entity over a specified period of time, usually a year. The Profit and Loss section of the Statement of Comprehensive Income will list all revenue, finance costs, tax expenses, and shares of associates and joint ventures' profit or losses. Anything else will be listed under Other Comprehensive Income, such as any gains or losses on the sale of property. The Statement of Changes in Equity explains any changes in the company's equity in the reporting period. This will show the total comprehensive income for both the parent and non-controlling interests. Effects of restatements due to errors will be listed in the Statement of Comprehensive Income, as will any retrospective application of accounting policies. The Statement of Changes in Equity will also list any movements in the equity, such as retained profit or loss, other comprehensive income, or changes to the ownership structure, such as share issues or buybacks. Finally, let's look at what's contained in the notes to the financial statements. These will have general information, such as the basis of preparation of the financial statements, the statement that they are in compliance with IFRS, and any other information which is not contained in the financial statements. They'll also list the accounting policies used in the preparation of the financial statements, any judgments that were made in order to come up with the financial statements, and also any estimates and uncertainties. Thank you for watching this video. If you'd like to learn more, please feel free to visit eruditeape.com.